There's a strange thing happening in AI right now. Some of the most important companies don't build models. They don't release products, and most people have never even heard of them. But they're already locked into multi-year contracts with the companies everyone is watching. When people think about AI, they think in terms of intelligence, better models, smarter outputs. That's the visible layer. But underneath that, there's a completely different game being played. A game of access. Access to compute. Access to GPUs. Access to infrastructure that very few players can actually build at scale. This is where CoreWeave shows up, not as another cloud provider, but as something much more specific, a system built entirely around one idea, running AI workloads as efficiently as possible. Traditional cloud platforms were designed years ago for web apps, databases, enterprise software. AI broke that model. CoreWeave rebuilt the stack from scratch. Instead of spreading workloads across regions, they use a flat, single-zone architecture designed for ultra-fast GPU communication. Their infrastructure is tightly coupled. GPUs, networking, storage, orchestration, all optimized for one thing: speed at scale. And this actually shows up in performance. Up to 20% higher utilization of compute, 8 to 10 times faster container spin-up, and materially faster training cycles compared to traditional clouds. These are not marginal gains. At scale, they completely change economics. In March 2025, SemiAnalysis awarded CoreWeave its highest platinum rating for operating large-scale 10,000-plus GPU clusters with high reliability, making it the only cloud provider to receive this designation. In November 2025, SemiAnalysis again awarded CoreWeave its Platinum Cluster Max ranking for the second time, making it the only cloud provider to achieve this distinction twice. But the real story isn't just technical, it's financial. CoreWeave doesn't sell usage like a typical cloud. CoreWeave generates revenue primarily through multi-year committed contracts with take-or-pay terms. These contracts typically span 3 to 6 years with a weighted average duration of approximately 5 years, granting customers dedicated access to specific GPU infrastructure at fixed prices. In other words, it locks customers into multi-year take-or-pay contracts. In some cases, customers even prepay 15 to 25% of the contract up front. That's not cloud economics. That's infrastructure financing. And then there's the relationship that matters the most: Nvidia. Nvidia is not just a supplier here. CoreWeave's strategic partnership with Nvidia provides preferential access to cutting-edge GPUs and enables CoreWeave to be first to market with new generation systems. In September 2025, CoreWeave signed a services agreement with Nvidia that obligates Nvidia to purchase residual unsold capacity through 2032, providing a meaningful guard for capacity utilization. Nvidia is a real strategic partner here. It owns equity, it allocates GPUs, it even backstops unused capacity through 2032, which means CoreWeave is not just buying hardware, it's plugged directly into the supply chain of the most constrained resource in AI. The scale is easy to underestimate. Over 250,000 GPUs, dozens of data centers, and more importantly, tens of billions in contracted backlog. As of the end of Q4 2025, CoreWeave's revenue backlog surged to $66.8 billion. This is a 324% YoY increase, driven by exceptional growth from new and existing customers, including large deals with AI labs, hyperscalers, enterprises, and AI natives. Notably, 42% of this revenue backlog is expected to be recognized within the next 24 months. But this is not a clean story. The business is extremely capital-intensive. Fiscal year 2025, CapEx totaled $14.9 billion, and management has guided for $30 to $35 billion in fiscal year 2026, more than double the prior year. Total debt stood at $21.4 billion as of December 31, 2025. Interest expense reached $1.23 billion for fiscal year 2025, with Q1 2026 interest expense alone guided at $510 to $590 million, implying an annualized run rate approaching 2.2 billion US dollars, tens of billions in capex, heavy debt, rising interest costs. And also the path to GAAP profitability is distant. This is a fragile balance. Any disruption to the financing model could materially impair the company's ability to fund its contracted backlog. Furthermore, customer concentration is high. A few large clients drive a significant share of revenue, and over time, hyperscalers may simply build this themselves. As we say, this is not a clean story. So the question isn't whether CoreWeave is important. It clearly is. The real question is this a temporary advantage created by GPU scarcity, or is this the beginning of a new layer in the AI stack? If AI keeps scaling the way people expect, the bottleneck won't be intelligence, it won't be models, it will be infrastructure. The ability to actually run these systems at scale, reliably, and economically. And that's where things start to get interesting. Because once you look at AI through that lens, the conversation shifts completely. It's no longer just about who builds the smartest model, it's about who controls the layer that every model depends on. And the companies sitting in that layer might not just participate in this cycle, they might end up shaping it. We broke this down more broadly in our last video on AI infrastructure, where the real leverage in this space might actually sit. And once you see that layer clearly, it's hard to look at AI the same way again.